Hey everyone, this is chapter 11 from Trading Price Action Trends, Late and Missed Entries. It's a pretty short chapter. I'm going to go over some of the main ideas that Al talks about, and then I'm going to play a clip from my podcast with Al where he pretty much explains this entire chapter in that clip. So, this chapter is pretty much about challenging the beliefs of a trader, and the main idea that Al's getting across is this one here, that holding long is the same as getting long. So there are times as a trader where you say, if you're looking at a chart here and you're thinking, I should be long right now, or you exited a trade early and you'd probably be holding some shares, but you think, I can't enter now because I'd be chasing. And Al's arguing that if it's a valid long and you're flat, it's the same as if you had been holding long. So you should just get long. At any point where you feel like it's a reasonable swing trade, you should just get long with the appropriate stop and appropriate size. So a good thought experiment to kind of solidify this idea that holding long is getting long is, let's say that you're a swing trader and you bought, let's say, the 5 close, which is right here, and you're holding long for a swing, and as you get a strong breakout above a swing high, you move your stop up. And let's say we're around here, bar 17, 18, and you accidentally close the trade. So you didn't mean to do it, you misclicked, and you exited the trade. Now you're flat. You know that you should still be long because you accidentally exited, but right now you're flat. So you don't second guess and say, well, I can't re-enter now because the stop is so far away. You say, well, I was long two contracts, and I accidentally exited the 2 contracts. Let me just quickly buy it again. So that's equivalent to just staying long. You meant to stay long, but because you accidentally got out of the trade, you're going to re-enter from a flat position, knowing that you were just long a second ago. Now, let's say that happens again on the next bar. You would exit the trade by accident, and you'd be flat, but you'd still know that it's a reasonable swing trade, and you'll get back in right away. If you think about that happening every moment, that you could accidentally exit the trade every moment and then re-enter constantly, knowing that it's still a swing you want to be in. That's showing that every moment that you're holding a swing trade, you're actually doing the equivalent of constantly exiting and re-entering, exiting and re-entering. And it's the exact same thing because you want to be long. Now, one important concept that Al mentions is that let's say you're long on bar 5. You bought the close and now you scaled out. So you bought 3 contracts and now you scale out 2 and you have 1 left around bar 17 and 18 around here. If you accidentally exited the trade, you wouldn't re-enter the trade with 5 contracts and put a stop 2 ticks below bar 18. You're going to re-enter the trade as if it's the valid swing trade that you were just in. So you're going to re-enter with just 1 contract and put the stop where it belongs. So when you're swing trading, regardless of if you're long or trying to get long, if you think it's a reasonable swing, you would enter the trade with the appropriate risk and the appropriate stop. So if the stop belongs here for a swing trade, then if you enter a long here, you're going to use the contract size that gives you the appropriate risk for what you want to risk and put the stop in the correct place. So when you're a swing trader and you see an active swing where you would have been holding long or you think it's a reasonable swing long, you should enter at the market with the appropriate size and the appropriate stop. The second main idea that Al talks about in this chapter is this idea of other people's money. So when you have an open profit, Al talks about how it is emotionally easier to hold a trade because you now feel that you're risking someone else's money. It's the market's money. But he argues that this idea of other people's money is a flawed belief system. If you have an open profit in a trade, you're 1 click away from having it in your account. So it's technically in your account, and whatever you do with that open profit, it's as if you're using your own money. It's kind of like if someone writes you a check and you decide to gamble it on roulette because you haven't deposited it yet. And so technically it's not in your account, so you can do whatever you want with it. That's not how you would treat any other type of money that's 1 step away from being in your account. And Al argues that you shouldn't do that with open profit either. So if you have an open profit, you have to treat that open profit as responsibly as you would your own money. And this idea of other people's money ties in well with the first point, that holding long is the same as getting long. Because Al talks about how if a trader buys the 5 close and holds through all this, at bar 17 and 18, they're much more likely to hold for a swing because they feel like they have a big open profit, and now they're only, even if they swing trade this, they're only risking the market's money, not their own money. Whereas someone who gets to the computer at bar 17 or 18, they're going to be much more reluctant to buy the close and swing because they're flat on the day. They haven't made any money. And so buying here and putting a stop down here looks like a big risk for someone who hasn't made any money yet. And Al talks about how that's a logical fallacy, that there's no other people's money and your own money. Any money, any open profit that's in your account is now your money, and you should treat bar 17 and 18 here the exact same way, whether you've made anything before with an open profit or you're completely flat and just starting the day. If it's a swing trade, it's a swing trade. You buy it, put the stop in the right spot, and manage it the same way. So now I'm going to show a clip of Al talking about these concepts in the interview I did with him.
And like I said, don't be hard on yourself. So if you're pretty good at trading bull flags, but terrible at trading breakouts, don't worry about it. Just trade the bull flags. Nobody's going to take most, and most people are going to see them a bar or two late, and they'll miss them. But if the trade is really good, you can enter late. Remember I said just trade small. Right. So if you don't buy above 49 or above 52, you can buy above 54, right? Your stop initially might be below 52, but you buy above 54 and just trade small. Once you see, I think one of the mistakes that traders make is if they don't take a trade, or if they miss a trade, and then the market starts to do what they thought it was going to do, they start saying, "Oh, I got to wait for a pullback." Well, if the trade is really good, you ain't going to get a pullback. It's just going to keep going on without you. So as soon as you tell yourself, "Oh, I got to wait for a pullback," as soon as you have that feeling, buy at the market and trade very small and use a wide stop. If you're hoping for a pullback, that means the market is really strong and everybody is looking to buy pullbacks, even really tiny pullbacks. So you're going to have to wait a lot of bars before you get a pullback that you want. Everybody else is buying, 1 point pullbacks, 2 point pullbacks, while you're waiting for a 10 point two-legged pullback. You're going to wait a long, long time, and you're missing a great trend. So, once you look at something and say, "Boy, I wish I took that buy the market." Buy small, 20% of your position, but buy the market. Anytime you look at a chart and say, "Boy, I wish I was long," you got to just buy. All right. Don't wish and don't wait for the pullback. Just buy. So swing trader could put a stop below the most recent low, but let's say he bought about 49, and the market's up here and he's still long, right? So now he has 25 points profit, and he's 25 points risk, right? That's too much to risk. So he'll take some partial profits. And a lot of traders did that, and that created these two bear bars. All right. And you wait for a bull bar closing near its high like that, and then go back to your full size position.
Right. So a scalper is more quick to exit, but they have to be quick to get back in when they see a bull bar closing on its high. Whereas a swing trader can use a stop below the prior low, but they're going to want to take part off when the risk gets too big and then add it back on above a bull bar, or when another setup presents itself. Is that accurate?
That's accurate. And a swing trader often has to risk more than a scalper. If you bought above 49 and put a stop below 48, your risk is small. But then the market does this, you have to take profits, because now your risk is from here, the current price, down to here. And you can say, "Well, it's other people's money." No, it's not other people's money. Look at your account. It's in your account. It's your money. And, you cannot risk that much. So you have to take profits. And that's why you get this. The computers are taking profits, and they wait to see if other computers start to buy. And if they do and form a bull bar closing near its high, the people who exited here go back to their full size position there.